on a leverage basis to the actual price of a product. Obviously, if you've got a million ounces in reserves and the price goes from 2,500 to 3,700, okay, so it's moved up 50%. But it's moved up more than that because as the price of gold moves up, you can bring more of your ounces into reserves. So things that had no or very little attributable value at a $2,500 price now have real value at a $3,700 price. So again, I mean, you know, this is obvious if you think about it, but I think it's worth really focusing on when you're looking at valuations. The value of reserves has gone up. The value of the mine production has gone up. Your cash flow has gone up. Everything has gone up dramatically.
Gold's momentum is revealing more than just rising prices. It's exposing a significant revaluation underway in the mining sector. As gold climbs from levels like $2,500 to $3,700, the change isn't simply a percentage gain on paper. What happens beneath the surface is that reserves once considered uneconomic at lower prices suddenly become highly valuable. Margins expand, cash flows grow, and companies holding large reserves see their balance sheets transform. This leverage effect explains why mining stocks, which lagged behind gold for years, are now starting to catch up as investors recognize the compounding value in rising reserves and production. AdrianDay, an experienced investment manager with decades of expertise in global resource markets, underscores this point by noting that gold miners have now delivered 9 consecutive quarters of industry-leading cash flow growth. With central banks and sovereign buyers focusing on physical gold while Western investors begin to shift their attention to miners, the setup is becoming far more favorable for gold equities. As the economic backdrop weakens, inflation stays stubborn, and interest rates trend lower, the opportunity in gold and gold stocks grows harder to ignore. Now, we present the clips from AdrianDay's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. And enjoy the video.
I mean, we know that for the last 3 years, really, gold has been moving up significantly, while the gold stocks until very recently, you know, meaningfully lagged. And then they started moving in tandem until, as you say, just the last couple of months. So, I mean, I think we all know why that is. It's because there have been the main buyers of gold have been people like central banks, Chinese non-official buyers, as well as wealthy families in the Middle East, as well as Asia, concerned about the fiscal situation around the world. And those buyers with those motives buy physical gold. They don't buy silver, they don't buy gold stocks. And so that's why until recently we've seen gold move up meaningfully relative to the gold stocks. And it's not illogical that people, particularly Western people, were not buying gold stocks. So it's not illogical. It's certainly not illogical that central banks were buying physical rather than buying gold stocks. But it's also not illogical that the traditional buyers of gold stocks were not buying gold stocks, because typically Western investors are attracted to gold for economic reasons, when the economic environment is favorable to gold. That's particularly true of North Americans who don't have this long history of gold as a defensive insurance asset. Whereas if you're German or French or Italian, you know very well the value of gold as a sort of insurance asset. And until recently, the economic narrative in the US was really not conducive to gold at all. You had a seemingly strong economy. You had high interest rates that were resistant to coming down. You had apparently low inflation, certainly after COVID. You had inflation that had come down dramatically, low inflation. And you had a relatively strong dollar. Now, I know, of course, that the first half decline of the dollar was the greatest first half decline since 1973 or 1974, I forget which. But if you look at a sort of 3-year, 5-year picture on the dollar is still relatively strong. And so all of those things said this is not an environment where you want to buy gold. On a 5-year basis, as people can see, it's come down from the peak, but it's still up from the bottom. It's not, it's not fallen apart yet. And then if you add to that the fact that the S&P is just continuing to go up, then US investors were really they weren't being illogical by saying, we're happy where we are, we don't need to look at gold. That, of course, has changed in the last month, not coincidentally, when the gold stock started to take off, as you pointed out earlier. We've got an economy that is clearly, even if you're a bull on the economy, clearly the rate of growth is slowing, and clearly there are problems in the labor market. Even Jerome Powell earlier in the week said he can no longer call the labor situation very solid. You've got interest rates obviously coming down. You've got inflation that has been stubborn. It's not running away from us, but it's been stubbornly, just moderately moving up. The trend line is certainly up over the last several months for CPI and PPI. It's not sort of dramatic, but again, it's above where we were before COVID, as your graph shows. And it's also meaningfully above the Fed's own arbitrary target. And it's just slowly picking up. So basically, since last summer, so we've had a year of it not running away from us by any means, but slowly moving up, but I think more significantly, well above the Fed's own target. Mm-hmm. This is assuming you believe the numbers. That's a whole different question. Right. So what I'm saying, and then of course the dollar, as I mentioned, had that meaningful first half decline, and the bounce from that decline has been extraordinarily modest so far. And so one can see that the economic environment is shifting towards an environment that's more conducive for gold. And in addition to that, obviously the S&P continues to move up. But I think more and more people are seeing that the S&P has moved up meaningfully lower, not only than the gold stocks, but meaningfully lower than gold itself, which is really quite astonishing when you think gold is meant to be a defensive, strategic, long-term asset. It's not a speculation. So the fact that gold has well outperformed the S&P for several years, I think that's beginning to get attention. I'll also say that some of the high flyers, NVIDIA, for example, I think the expectations for continued growth are probably unrealistic. I mean, a stock like NVIDIA simply cannot continue to grow for the next 5 years the way it has for the last 5 years, or it will be the only stock in the world. So that's a slight exaggeration, but not much. So what I'm saying is I think not only is the environment shifting towards one that's conducive for gold, but investors are finally looking at the gold stocks, seeing the performance, seeing the huge margins and the growth in cash flow, which is another thing. I mean, we've had 9 quarters now, 9 consecutive quarters where the gold stocks have produced growth in cash flow greater than any other industry segment. And investors, particularly professional investors, investment advisors, are beginning to recognize that. To the actual price of a product. Obviously, if you've got a million ounces in reserves and the price goes from 2,500 to 3,700, okay, so it's moved up 50%. But it's moved up more than that because as the price of gold moves up, you can bring more of your ounces into reserves. So things that had no or very little attributable value at a $2,500 price now have real value at a $3,700 price. So again, I mean, this is obvious if you think about it, but I think it's worth really focusing on when you're looking at valuations. The value of reserves has gone up. The value of the mine production has gone up. Your cash flow has gone up. Everything has gone up dramatically.
Silver remains a unique market because so little of its production comes from dedicated silver mines. With only about a quarter of global output sourced from primary silver operations, the majority arrives as a byproduct of gold, copper, zinc, or lead. This structure makes silver far less responsive to higher prices. Producers won't build a new lead or zinc mine just because silver is rallying. The result is higher volatility and tighter supply when demand surges. At the same time, gold equities still present compelling value. Historically, when gold gained 40%, mining stocks leveraged those moves by over 3 times. Today, that leverage is closer to just above 2, leaving significant room for outperformance. Until recently, the major buyers were specialist investors and significant funds, while ordinary retail investors remained absent. That began to change in late August, when inflows finally returned to ETFs like GDX and GDXJ, signaling a broader participation wave could be starting. Against the backdrop of an unsustainable U.S. debt trajectory, rising rollover costs, and fewer foreign buyers of treasuries, the stage is being set for a funding crunch that could drive more capital into hard assets. Let's get back to the interview.
The big difference with silver, of course, is that there are relatively few pure silver mines. Maybe a quarter of the silver production in the world comes from primary, not necessarily pure, but primary silver mines. So an awful lot of silver is not just a byproduct of gold and copper, but it's also the byproduct of zinc and lead. And so it tends not, silver output tends not to respond very directly, frankly, and certainly not in a short period of time to increases in the price. Again, you know, if you run a lead mine in Bolivia where 10% of your revenue comes from silver, well, you don't go out and build another lead mine just because the silver price is up. So silver production doesn't respond very well to silver price on the upside and the downside, incidentally, which is one of the reasons that silver prices are more volatile than gold. One of the reasons that it's more volatile than gold's price. But the analysis of the price having gone up and not the costs absolutely certainly applies. But I think it's important people realize, again, getting back to the theme that you haven't missed this market, gold stocks are still really good value. I mean, the last time gold was up 40%, you mentioned 40% in the last year. I think that's what you said.
Yep.
No, it's 40% this year, sorry. So if you look at the last time gold was up 40%, the gold stocks had 3.6 times leverage. Now we're only like 2.2 times leverage. So, you know, you can look at a lot of things. You can look at the leverage, you can look at the valuations. A lot of things tell us that the gold stocks are still good value with a lot more room to move. And the last point I'll make is, you know, look at the flows. Obviously, someone's been buying the gold stocks this year, but I think it's not been what I call ordinary everyday investors, ordinary everyday investment advisors, generalist funds, generalist investors, and so on. It's been gold specialists, it's been sophisticated investors, you know, people like Druckenmiller and Paul Tudor Jones and Ray Dalio, and it's been the Elliott firm investment management up in New York. It's been people like that. It's not been ordinary investors. And you know, most ordinary investors, when they turn to gold, at first, they'll buy the GDX or the GDXJ. And that's what an investment advisor is going to buy. You know, if the dentist in Oklahoma calls his broker, who's a financial advisor at Schwab, and says, I want to buy a little bit of gold, he doesn't say, let me buy Ajax Exploration for you. No, they buy Barrick, Newmont, or the GDX. So if you look at the flows, even while gold was moving up, throughout this year, the GDX and GDXJ was seeing extraordinarily consistent outflows. And that's really just changed the third week of August. We just saw the change in flows to inflows in the third week of August. And even there, it's not been steady. The GDX, for example, I'm just looking at my notes, has lost 250 million. That's $250 million in outflows in the last month. I mean, it's quite extraordinary. It's lost $3.5 billion this year. But at least what I'm saying is you can see that in the last month, we've started to see some flows come into the GDX and particularly the GDXJ. And that to me is an indication of ordinary investors, non-specialized, not professional investors, are beginning to move into this sector. To look at the debt situation, obviously fundamentally the debt situation in the US is just extraordinarily bad and just continues to get worse. There's been a little bit of relief in the last month, however. The tax returns, a lot of tax receipts come in September, as you probably know. And that's where people make the catch-up payments from what they estimated in April. And then September is for the deadline for companies. And for a lot of I was going to say wealthy, I'm not wealthy, for a lot of business owners, once you've got the business return, then you've got your individual done right away, right? Because you know what your capital gains are in April. You know what your interest and income is in April. You're just waiting for the accountants to finish your business return before you can file your tax return. Anyway, the point is September is a big month for tax receipts, and tax receipts came in a lot higher than were expected. So that's relieved a little bit of the immediate pressure on the funding, but it's still fundamentally a major problem because the debt continues to go up with the, as we know, and with the debt ceiling only removed in July, they've had to compress a whole year's worth of bond buying. They were only able to roll over until the debt ceiling was raised. They were only able to replace what matured. They weren't able to increase. So you've got that whole year's worth of increase compressed into 4 or 5 months. Fiscal year ends October. So, and yet at the same time, you've got fewer of the traditional big buyers, particularly foreign buyers, stepping up to the market, so stepping up to the table. So it's fundamentally a difficult situation. And the thing that's of most concern to me and to many others is, Janet Yellen financed entirely at the short, or almost entirely at the short end, which I think was a disaster, very bad policy. But all of the bonds that were issued 3 years ago, 5 years ago, 7 years ago, that are coming due now, they were issued at 1.5%, 2.5%, 3.5%, depending on when they were issued. But whenever those were issued, you're having to pay more when you roll them over right now. And so right now, the average across, the last number I saw for the average interest rate across the entire federal debt was something like 3.4%. But as you roll them over, it's clearly moving up. Yeah, significantly up, which makes, because you can't get 3.5%, you can't pay 3.5% for debt anywhere across the spectrum. And so that's meaning that the debt service is just inexorably moving up. Regardless of anything else that's happening, regardless of the debt itself moving up. And they're going to have to find buyers. And, obviously, Scott Bessent, the Treasury Secretary, he's using the normal bag of tricks that Treasury Secretaries use. He's also, we've also got the stable coins, where with in exchange for light regulation, if they're 100% backed by treasuries, they get light regulation. So that's going to be a source of demand for treasuries, a new source of demand for treasuries. It's unlikely to come in the next couple of months because you've got to set up the fund, you've got to get approved by the SEC and so on and so forth. So maybe that'll have some significance next year. The estimates from people who follow this stuff that I've seen amount to about 250 billion, which is really nice, but it's only a small part. It's only a building block when it comes to refinancing the entire debt. The banks were given, the banks were told they didn't have to put so much on reserve with the expectation that they would increase their buying of treasuries. That's not happening in any meaningful sense. That's not happening at all. And of course, Jamie Dimon, the chairman of Chase, I think he said something like, well, I don't want any more treasuries on my books. But the banks that have to hold the treasuries to maturity, are not, they're not doing particularly well on that trade. They can't mark to market, they have to hold them to maturity. So Yeah, so some of the traditional buyers of bonds are not there. So I think over the next year we're going to see potentially a crisis in the funding market, which will mean, what will that mean? Well, it will mean one of two things. It might mean that the yield curve steepens significantly, so that to attract buyers at the long end, you just have to offer them more to start with. The institutions with long dated liabilities like pension funds, insurance companies, they're going to buy long dated assets anyway, because they have to. They have to try and match their maturities with their assets. But people who have the option of buying or not buying, I think are going to want a higher interest rate, to attract buying. So the possibility is that the Federal Reserve institutes another round of QE. They won't call it QE, but they are the obvious institution that can come in and mop up the excess treasuries in size. Powell has said he won't. He said the fiscal situation is the administration's problem. It's not the Fed's problem. But I mean, we've seen what the Fed, not Powell himself, but we've seen what the Fed has done before. So I suspect that's how it will end.
The market landscape is shifting in ways that demand close attention. Debt pressures are building, rollover costs are climbing, and the once reliable base of foreign buyers is stepping back from U.S. Treasuries. At the same time, central banks and sovereign players are quietly building positions in tangible assets that cannot be diluted or defaulted on. This dual reality, fragile paper markets on one side, rising confidence in hard money on the other, creates an inflection point that few investors are prepared for. Professional investors, funds, and even mainstream advisors are starting to acknowledge that traditional equities may not provide the same level of safety or returns going forward. Instead, gold, silver, and the companies that mine them are positioning themselves as a critical hedge in an increasingly unstable environment. When ordinary investors finally recognize this shift, the flows could accelerate dramatically, fueling a long overdue revaluation. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.